This is BDC Navigator. Let's get started. Some stocks pay 10% dividends and they're completely legitimate. Others pay 10% dividends, but they're quietly falling apart. And here's the problem. To most investors, they look exactly the same. Today, I'll explain what business development companies or BDCs actually are, why they replace banks, and the three numbers that tell you if a BDC dividend is strong or could potentially be moving in the wrong direction. Let's take a look at Investopedia, a real handy website that I've always used to get some definitions. It says here, understanding business development companies or BDCs and some investment tips. Now, we're not going to get any tips, but we are going to look at the definition. And it says they're created by the U.S. Congress in 1980. Business development companies or BDCs are specialized, closed-end funds designed to fuel economic growth by investing in small to medium-sized businesses. So today, we're going to look at three numbers that tell you if a BDC's dividend is strong or that it could be potentially moving in the wrong direction. Now, before we start, understand this. BDCs are one of the few ways that regular investors can tap into the private credit market, a market with an estimated worth of $2 to $3 trillion. There's been a lot of headlines lately over the past several months about the problems and concerns with private credit, and BDCs are a part of that system. So, if you buy the wrong one, you don't just lose your yield, you lose your capital. And we'll talk more about that. This is true of any investment, so don't let that scare you. Now imagine there's a giant stone dam at the top of a river, and for 100 years, this dam, the big bank or big lender, controlled all the water. So to use this analogy, if you were a fox starting a factory downstream or a rabbit building a tech company, you went to the big bank and asked nicely, and the gates opened. Businesses grew, crops flourished, and everyone ate. However, after the GFC of 2008, the dam changed. The gates rusted, the guards got angry, and suddenly the big bank started yelling things like Basel III and capital requirements and stress tests. Now that dam only opens for the biggest animals in the forest. The foxes and the rabbits, the small to medium-sized businesses, well, they're kind of stuck out there on the dry dirt. Now, this is not fairy tale. This is exactly what happened to lending in the real economy. And here's why this matters to you. When banks stop lending, businesses still need money. They need capital. They still need loans to grow. So what happens? A massive vacuum forms, and in finance, just like in nature, a vacuum always gets filled. Now, while the stone dam was busy arguing with regulators, a new creature entered the river, the navigator beaver. Now, beavers don't build giant stone fortresses. They build flexible log dams. They move fast, they customize, they don't care about the same rules because they're not held to the same standard. It's a different investment instrument. Now, in the world of finance, this is called private credit. Now, to understand private credit, let's take a look at the Federal Reserve, the banking system for the United States, and see what it has to say about bank lending to privates. So this is their website, and this is the page that talks about bank lending to private credit, the size, the characteristics, and the financial stability implications. So real briefly, here at the top, it says private credit has emerged as one of the fastest growing segments of non-bank financial intermediaries over the past 15 years. There's also no universal definition. Private credit generally refers to direct loans made to mid-market businesses, typically by non-bank vehicles such as private debt, business development companies. Now, private credit has emerged as one of the fastest growing segments of non-bank financial intermediaries over the past 15 years. Well, that's a couple of years after 2008 and the great financial crisis. It says, although there's no universal definition, private credit generally refers to direct loans made to mid-market businesses, typically non-bank vehicles such as private debt funds and business development companies. So that's where business development companies fit into the financial system as it's discussed by the Federal Reserve. So this form of private credit is basically lending money outside traditional banks. So today, instead of going to a big lender like JP Morgan, Bank of America, Citibank, or any other large and traditional lender, a company goes to a private lender. And the lender says, well, we'll fund you, but we have to charge a higher interest rate. We want collateral, we want control, and after 2008, things really began to expand in the use of BDCs. Firms like Ares, Blue Owl, and Blackstone became the new kings of the river. Now here's where the average investor asks, but how do I get paid? What's my investment return going to be on this investment vehicle? So because private credit usually isn't available to regular people, the average investor, which brings us to the most important part of the entire video. A BDC is a business development company, and the simplest way to understand it is a BDC is a private credit beaver dam. If we take this scenario, now as we know, we've already defined a business development company, or BDC, is private credit, and we're going to use the analogy of a private beaver dam. So what happens is you as the investor can buy shares in that beaver dam or that BDC. It's a public company which raises money from investors, then lends it out to private businesses. So when you buy a share of a BDC, you're giving the beaver more sticks to build the dam, and in return, you get paid interest income. That's why BDCs often have a higher dividend yield, like 8%, 10%, even as high as 12%. Now here's the legal cheat code that makes them famous. BDCs are required by law to pay out at least 90% of taxable income to shareholders, meaning they are literally built to distribute cash. But don't get hypnotized by the yield, because here comes the trap. Here's the challenge. A 12% dividend yield can mean one of two things. It can mean a BDC is a cash machine, or it can mean the market is screaming the dividend is about to get cut. And the reason comes down to one thing: the quality of the logs or the quality of the loan portfolio. Okay? So let's bring in the beaver. Here's what makes BDC so powerful. Banks have a problem. Their money can leave at any time. Depositors panic, the bank collapses. We saw this happen in 1929 after the stock market crashed, and the subsequent following next year or so, people panicked. They ran to the bank, and the bank only had the amount of cash that it had actually physically sitting in the vault. So if you got there first in line, you got your money back. If you did not, and the bank was exhausted in terms of what their financial assets were that they had on hand, that was it. And so that was a big problem and created the conditions that started the Great Depression. Now here's what makes BDC so powerful. Banks have a problem. Their money can leave at any time. Depositors panic, they can withdraw their funds, and the bank collapses. Or at least that's what happened after the stock market crashed in 1929 and caused a bunch of bank failures. But a BDC has something that banks don't: permanent capital. Once investors buy shares, that money stays inside the structure. We've heard information lately about the 5% withdrawals, and these BDCs beginning to put caps on how much money can be withdrawn for over a certain period of time. Okay? Now the beaver can be patient. The BDC, he can write longer loans, he can demand higher interest, and he can lend to companies banks refuse to touch for whatever reason. This is why private credit is becoming the oxygen of the economy. On average, what I've read and researched, a loan can be generated in 6 weeks. So when a company comes in and talks to a BDC and goes through their process, 6 weeks, probably best case scenario, that business can be withdrawing the funds in the form of a loan from that business development company. Now this creates a huge danger, because when you lend to risky borrowers, some managers can get a little bit hungry, but it also creates a huge danger, because sometimes you can lend to more risky borrowers. Some managers get a little bit hungry. We're seeing a lot of press information and discussion take place about the SaaS, which is software as a service. And it set off a little bit of a panic in the high-tech companies in the stock market. Not all beavers are good builders. Some use wood that they shouldn't be using. It's beginning to rot, okay? Great analogy, makes it simple to understand. Not all beavers are good builders, however. Some use wood they should not be using. It's beginning to rot or fall apart. So sometimes they'll lend to companies that are already maybe extended in debt, or there could be a number of different scenarios that might not make that risk the best risk at that particular time to be investing in. Now, while the economy is strong, nobody cares. Nobody notices. The dividends keep flowing. Investors get addicted, but when the economy slows down, as we go through business cycles, the dam starts leaking. First, borrowers stop paying their interest payments. Then the earnings drop. After that, the NAV or net asset value declines. Then the dividend gets cut. Then the stock price collapses, and suddenly your safe income investment is down 40%. Warren Buffett was famous for making this statement: when the tide goes out, you find out who has been swimming without the proper attire. Let's put it to you that way. So a couple of the risks: non-paying loans begin to rise, NAV begins to fall, dividends get cut, and then the stock begins to drop in value. So the real question isn't which BDC is the highest yield. The real question is which BDC is built to survive a recession. I often think many times the saying that Jamie Dimon from JP Morgan Chase Bank has said. He talks about the fortress balance sheet. And this references, hey, his bank and his business and his philosophy are built to not just survive, but to thrive in any environment. And this brings us to an important part of the video. If you want to avoid dividend traps, you need a simple framework. I call it the 3-number BDC safety test. These 3 numbers reveal a few important things. They'll tell you whether a beaver is building a strong dam with good logs or not the strongest dam because it's not choosing the best wood, i.e. the best loan portfolio. So number 1, non-accruals. So non-accrual loans are loans where borrowers stop paying interest. This is not good for a BDC. A little is normal, but if the non-accruals start rising, this is a warning sign that the portfolio may be starting to crack. Number 2, NAV trend. NAV stands for net asset value, basically the value of the BDC's portfolio minus its debts. Let's take a look at what Investopedia has to say about NAV. The definition, the formula, the examples, and the uses. It says down here, net asset value, NAV, is the difference between a company's assets and its liabilities calculated at the end of each business day. The NAV is the value of an investment fund that's determined by subtracting liabilities from assets. The per share NAV is calculated by dividing the net asset value, or NAV, by the number of shares outstanding. NAV and NAV per share are calculated for funds such as mutual funds or unit investment trusts. That's calculated at the end of each business day using the closing market price of the portfolio of securities. So if the NAV stays stable or rises, that's a strong sign the loans are healthy. But if the NAV is slowly declining year after year, this means the BDC is losing value. And here's the key. If the NAV stays stable or rises, that's a strong sign that the loans are healthy. However, if the NAV is slowly beginning to decline, that means the BDC is losing value. And here's the key. A BDC can still pay dividends while the NAV is falling, but it's like eating your own seed stash to survive winter. Eventually, you're going to run out. Number 3, dividend coverage. The 3rd number is dividend coverage. The main metric here is NII, or net investment income. Let's take a look at what Investopedia has to say about net investment income. It says the NII, or net investment income, for tax purposes is the total amount of money received from assets such as stocks, bonds, and mutual funds minus related expenses. It may include interest income, dividend income, and capital gains. Whether this income minus the expenses is taxable is determined by the taxpayer's modified adjusted gross income. That's what NII is. In simple terms, is the BDC earning enough income to pay its dividend? So if it earns 40 cents a share and is scheduled to pay 40 cents a share in dividends, that's healthy. The BDC can pay its dividend. If it earns 30 cents a share and still has to pay 40 cents a share, then the dividend is being propped up. And that's when you get into cuts. If you track these 3 things, non-accruals, NAV trend, and dividend coverage, you're already ahead of most dividend investors, because most people don't invest. They chase yield and yield chasing is how you get eaten alive in the BDC world. Now here's the best part. BDCs are required to disclose their portfolio. They leave a blueprint. It's called the Schedule of Investments. Now most investors skip this because it looks pretty boring, but it tells you everything. What industries they lend to, how diversified they are, which loans are struggling, and whether the portfolio is quietly deteriorating. On this channel, we read the blueprint because we're not gambling squirrels. We're forensic squirrels. In the next video, we're going to take a look at what I call the three kings of the forest, the biggest BDC players in the entire river system. And we're going to answer three questions. Which one has the safest dividend? Which one has the strongest portfolio? And which one could be having some problems underneath the surface? So what we're going to do is we're going to pop the hood on these investments and take a look at the schedule of investments and what's inside. This is really kind of fun. So I encourage you to join us. Because one of these three kings is a fortress. And in the next video, we're going to take a look at what I call the three kings of the forest. These are the popular names that you hear discussed on financial news, the biggest BDC players in the system. And we're going to take a look at three different questions. One, which one has what we think to be safest dividend? Number two, which has the strongest portfolio based upon our research? And which one may be having some trouble underneath the surface that we want to dig into a little bit deeper? Because one of these three kings is a fortress, and one of them could be a dividend trap that we kind of want to avoid. So if you want to be an investor that's educated and you want to be the part owner of that beaver dam, subscribe. Because of this channel, we don't guess, we don't hype, we do our research, we read the filings, and we follow the numbers. And we find out which beaver dams or which BDCs are standing on solid ground. I'm the navigator. Let's take a look at the data.